Surface stability often masks severe underlying stress. What looks solid at a glance can crack instantly when you account for the hidden pressure underneath. Today's Nifty 50 close at 24,636, a marginal positive tick of 0.05%, presents exactly that kind of illusion. On the surface, a green close looks like a green light for immediate continuation, trapping retail traders who enter the market expecting the rally to resume at tomorrow's open. We have to determine if the internal architecture of this close is built for a breakout gap up or a structural gap down tomorrow morning. Relying solely on the closing price is a gamble. True predictive edge requires analyzing the institutional plumbing beneath the surface. To reverse engineer tomorrow's open, we stack three distinct layers of hard data. First, we evaluate short-term momentum through immediate price action. Second, we map the aggregate open interest to identify the rigid structural boundaries built around the current price. Finally, we analyze participant net positions. By tracking the specific actions of smart money, we can identify points of divergence between institutions and the retail crowd. By synthesizing these three layers, the evidence points to a high probability gap down or negative open for tomorrow's session. This 15-minute technical view shows the Nifty's behavior leading directly into the close. Notice the price action approaching the 24,650 to 24,700 zone. Upward momentum has stalled, forming a cluster of lower highs, suggesting buyers are unwilling to commit here. We can confirm this lack of buying pressure by looking at the MACD indicator. Right as price hit that ceiling, the blue MACD line crossed below the orange signal line. The histogram bars are shrinking towards zero, confirming that bullish strength is evaporating. A MACD rollover on a 15-minute chart at the end of a trading day indicates that the momentum supporting the intraday move has reached exhaustion. From a technical standpoint, the index is hovering at the edge of a ledge without the necessary volume or momentum to stay there. Moving from price action to the options chain reveals where market makers have established major supply zones. The aggregate data shows a massive macro imbalance: 2.52 crore puts against a staggering 4.61 crore calls. This nearly 2-to-1 ratio creates a massive structural overhead bias, often referred to as a call wall. The heavy resistance is concentrated in the red bars at the 24,700 and 24,800 strikes. These levels act as a concrete ceiling, defended by market makers to prevent the index from moving higher. To find the downside floor, we have to examine the put writing at lower strikes. The green bars show structural support levels at 24,600 and 24,500. While some defense exists at 24,600, the true structural floor, the area where the largest block of puts is written, is not found until 24,500. The option structure has boxed the market in, but the sheer weight of that 4.6 crore call wall caps the upside and forces the path of least resistance downward. Finalizing this derivation requires identifying the specific players building the call wall. Who exactly is holding the market down? We'll start with the retail or client sector to gauge the prevailing herd sentiment. Retail clients are positioned for a breakout, adding over 18,000 net long contracts and futures and purchasing more than 2.3 lakh net calls. The foreign institutional investors, or FAIs, are behaving differently. FAIs have placed an aggressive bearish bet, holding over 1.5 lakh net short contracts in the futures market. Finally, we check the proprietary desks to find the source of the option ceiling. Proprietary traders have sold over 2 lakh net calls. This massive volume of call writing by professional desks is the direct cause of the structural resistance capping the market. The conflict is clear. Retail traders are holding long positions based on hope, while institutions have dropped massive iron anvils in the form of futures shorts and call walls. When retail goes long into a heavily fortified institutional short position, the resulting trapped liquidity becomes the catalyst for a gap down. Our derivation is complete. Technical momentum is dead. Upside is capped by a 4.6 crore call wall, and smart money is aggressively positioned short against the retail longs. Based on this data, the overnight bias is firmly negative. The heavy institutional architecture we've uncovered is fully designed and positioned to push the overall market lower at tomorrow's opening bell. Tomorrow's trading plan prioritizes defense based on these parameters. Fade bounces near the institutional call wall between 24,700 and 24,800. If the gap down accelerates, watch the 24,500 to 24,600 zone for put defense. While price will certainly fluctuate during the session, these macro levels dictate the true boundaries of the market. Amateur traders react to the color of the closing candle. Professionals trade the structural reality.